First, let me explain the question. The question refers to what we call the Goldilocks scenario in the market. And that goes back to the fairy tale about the three bears where Goldilocks comes in and eats the porridge, and this porridge is not too hot, this porridge is not too cold, this porridge is just right, except we're changing the metaphor to use the economy instead of a bowl of oatmeal. The feeling right now is the economy is not running so hot that the Federal Reserve will be forced to cool it off any further, nor is it running so slowly that it'll cause an impediment to economic growth. But by the way, if it does, the Fed will be there to come into the rescue anyway. Right now, that's very much the premise which the market has been operating on, more or less since the Fed eased off the brakes at the end of last year. The question, though, is the economy running? I'm not as concerned about the economy running too hot right now. I am a little more concerned about the economy running too cool. This morning, Tuesday, we heard the IMF downgrade their growth forecasts. Of course, that's only one of many international experts chiming in on the economy. But what worries me a bit more is what the bond market has to say. And the bond market is now starting to price in easing, the Fed easing into the market. It's not clear to me that the Fed sees conditions as weak enough to be actively easing monetary rates, having just raised them. Or if that is the case, where the Fed really will see the need to lower interest rates in the economy, that's not necessarily a good sign for stocks, because what that's saying is that stocks are much more sanguine about the prospect for earnings growth than the bond market is. One thing I've learned over the years is over time, and it's tough to say what over time means, but over time the bond market tends to get economic questions righter, more correct than the stock market. Because really, when you think about it, the bonds have so many fewer variables. It's really the level of interest rates and the level of, which are driven by the level of economic activity and the level of monetary accommodation. With stocks, there's so many more factors that cloud the picture. So over time, and now that over time can mean weeks, months, almost even a year or so. But generally, the bond market is more correct than the stock market over the longer term. And so what concerns me, especially as we go into earnings season that begins later this week and really starts to get into full swing next week and thereafter, is what are companies going to say about their visibility? Are they saying that the economy is chugging along nicely? Are they concerned about growth prospects? There'll be a lot of information held in that guidance, and that will really be able to tell us whether or not the Goldilocks scenario holds. One thing that I don't want to extend in the metaphor is at the end of the story, Goldilocks ends up getting eaten by three bears. It's not clear that we're ready to see that happen now, but that unfortunately is the end of the story, and that unfortunately is the end of pretty much every Goldilocks scenario in the market. When that happens, though, we'll get a lot more clarity as companies tell us.